Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we're going to talk about how Sofi Technologies has popped up in their overall share price and what this could mean for investors. After that, we'll be discussing an article that's going to dive into Palantir's future earnings report projections and how the stock market could react to these results, and whether or not this is going to be positive or negative for Palantir shareholders. Up next, we'll talk a little bit about Nio stock, pertaining to how their revenues may not be as impressive as some people think, on top of why the overall share price is falling. However, we'll also be talking about their overall PS ratio and how the second half of 2023 is anticipated to increase their overall share price, so stay tuned for that. And then lastly, we'll discuss Tesla's latest updates regarding their Q1 earnings report and whether or not this is going to be a positive development for the share price or a negative development, on top of their latest news updates and catalysts that are coming up for this particular company. So for more videos just like this one, don't forget to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. Sofi Technologies, ticker symbol SOFI, is a fintech company or a financial technology company that essentially operates as a digitalized bank. They offer an all-in-one inclusive digital app which gives their consumers access to various financial services and financial products all at their fingertips. And recently, banking stocks have somewhat surged, including Sofi Technologies, due to very impressive earnings reports that we have received from multiple financial institutions. Now, clearly, Sofi Technologies has not released their earnings report yet, because that is going to come a little later. However, as Sofi Technologies' earnings report approaches, investors are getting excited due to other banks bringing in relatively impressive results, which is reflecting very positively on the entire banking space. Sofi shares are experiencing an increase, which is good for shareholders. However, there doesn't seem to be a lot of heavy trading. For instance, recently only around 8 million shares have been traded, which is a drastic decrease from the formal or regular 36.4 million shares that normally trade hands daily. So this lower amount of volume is somewhat concerning, but hopefully Sofi Technologies will bring in a very positive earnings report to where it will reinvigorate investors' trust and confidence in this company and stock. Overall, I can't wait for them to release their overall earnings report, and in a future video we will be going over those exact projections. But as of right now, it's good that Sofi Technologies, as well as the general banking space, is increasing in their overall value, which should represent a breath of fresh air to investors despite the economic volatility that we have seen as of late in this exact space. So if you are a Sofi shareholder, feel free to hold your breath for the upcoming earnings report, because overall I think it's going to be positive, but I will be making a separate video on that exact topic. Moving right along here, let's talk about Palantir Technologies regarding how the market is seeing Palantir right now and how this could positively impact their overall PLTR shares. Palantir recently closed at around $8.73, and if you're not familiar with this company, Palantir Technologies is a big data and analytics company which serves both commercial enterprises as well as government clients. Palantir is also a leader in artificial intelligence, and their platforms are known for number crunching large data sets, which helps management make data-driven decisions. Shares have recently gained around 8.91% over the past month, beating both the business services sector, which only gained around 3.21%, and it also beat the S&P 500, which gained in the same period of time 6.17%. So for some reason, Palantir is actually increasing in their overall share price pretty dramatically, and I think I know why that is, because they are approaching their overall earnings report. Wall Street is looking for positivity in Palantir's upcoming earnings report, which is anticipated to release on May 8th of 2023, and the company is expected to report an earnings per share of 4 cents per share, which reflects a 100% increase from the prior quarter. On top of that, their revenue projection regarding their net sales is supposed to come in at around $504.84 million, which is a 13.1% increase from a year ago. Although this does fall below that 15% CAGR that we want them to achieve, 13.1 is not that bad, but mainly investors are focusing on their incredible earnings per share increase. For the entire year, Zacks consensus estimates for the entire year, analysts forecast that Palantir will bring in 20 cents cents per share and revenue of $2.2 billion. That would mean that their overall earnings per share would increase around 233.33%, which is phenomenal, while their overall revenue is going to increase by around 15.51% on a year-over-year basis, which would meet our 15% CAGR. Now, investors are not happy about Palantir's CAGR in regards to the revenue, but I think once the economy starts to pick back up, this should return to the high teens or low 20% improvements, which will increase their overall share price. But right now, investors are more focusing on their overall earnings per share, which is growing very impressively, and that is why investors and analysts alike are excited for their upcoming earnings report. Now, this is going to be a double-edged sword because if they miss on their earnings per share or their revenue, clearly the share price will fall, but as of right now, it looks like Wall Street in general and various professionals anticipate a large earnings beat, or at minimum for them to meet their overall expectations, which is going to reflect positively on the PLTR stock price. Zacks consensus estimate currently has a buy rating for this company because they, in their proprietary ranking system, evaluate companies on a scale from 1 to 5, where 1 represents a strong buying opportunity while a 5 indicates a strong selling opportunity. Zacks, due to these very positive news updates regarding Palantir's earnings per share and revenues, has a consensus estimate of a 2, meaning that this company is a buying opportunity before their overall earnings. For me, I still have a hold rating on Palantir Technologies, but I do agree with this institution regarding how their upcoming earnings report is going to be very positive, which should increase the overall share price. So if you are a Palantir stockholder, then this is going to be great news and a phenomenal news update for you. Up next, let's talk about Nio Stock and how there is little excitement around their revenue growth, but over the long term, this company seems primed for absolute dominance in their respected space. Nio is an EV company or an electric vehicle organization located over in China, and right now they trade at an impressive PS ratio of just 2.3 times. A low PS ratio can indicate that the company is undervalued, meaning that it's a great buying opportunity, and a high PS ratio can indicate that the company is overvalued. Thankfully, Nio actually is trading at a lower PS ratio than the majority of auto companies over in the United States. Many of these other electric vehicle manufacturers and automotive companies trade at around 4.9 times or 10 times regarding their PS multiple. This means that Nio, since it only trades at 2.3 times, is a great buying opportunity, and it means your money is going to go farther in this company than it would in other companies in this exact same space. From a value standpoint, Nio is a phenomenal growth company that is packing a lot of value, even though this company is not profitable yet. But it is good to see that Nio is trading at a low PS ratio, at least compared to their competition, because it makes them a better buying opportunity for investors. Many experts, analysts, and professionals all agree on the consensus that Nio is not anticipated to unveil impressive revenue performance over the next few quarters. However, once we get past quarter 2 of 2023, their quarter 3 and quarter 4 results should be impressive. Even though I think that they are still growing quite aggressively, considering that last year they delivered a 36% CAGR in regards of their top-of-the-line growth, and their future 3-year earnings and revenue predictions are anticipated to balloon even higher, to where the next 3 years the company should generate around 45% on a compounding annual growth rate in regards to their revenue, meaning that after this year, the company is anticipated to scale rapidly their overall financials. And once the company does that, their share price should also increase and start to gain value for their investors. So if you haven't invested into this company already, the best thing for you to do, in my opinion, would be to wait it out until quarter 3 of 2023. And then once the company starts to prove themselves in regards of their revenue growth, then that's the time to start investing into this overall company. Even though I do think there are other really good companies out there. I like Nio for their battery swapping stations, but I also like Li Auto as well as BYD over in China. For the United States, I am a huge fan of Tesla, and Tesla makes up the majority of my overall electric vehicle portfolio. However, overall, analysts are excited about the future forecasts of Nio, but over the next 2 quarters, Nio could experience some more pains, just like it's experiencing now by falling by around 6.71%. But there are fantastic catalysts for this company, such as new vehicle models coming out, new charging stations, and battery swapping network stations being implemented on highways highways and major cities, as well as this company aggressively growing their overall revenues. But with that being said, there is still political economic risk because this is a foreign company and you have to invest into ADR shares even to own this company, which means you're going to be charged a slight fee. And if anything politically were to happen between the United States and China, this company's share price would absolutely plummet. But from a risk to reward ratio, this seems that there is far more reward than there is risk. So I would at minimum nibble at this company, no more than a 2 to 3% portfolio allocation for this company. But overall, I am still an owner of it, but Tesla is still my number one EV investment as of right now. Speaking of Tesla, let's jump over and talk about Tesla's price cuts and what their Q1 earnings report will consist of. If you didn't know, Tesla has slashed the prices of their electric vehicles multiple times this year. For instance, their Model 3 and Model Y electric vehicles are getting cheaper. So is this good news or bad news? Well, Tesla saw the Model Y SUV be slashed by $3,000, and their Model 3 rear-wheel drive dropped by around $2,000 to just $39,990, making it much more affordable for people such as you and I. Even though I still think they're a little bit more expensive, I can't wait for Tesla to come out with a $25,000 electric vehicle, which most likely will come out around 2025. However, the good news is that Tesla is releasing their Q1 earnings report, even though it's not going to be as impressive as past reports, and here's why. Right now, professionals are projecting that Tesla will bring in around $23.37 billion worth of top-of-the-line revenue growth and earnings per share of 0.86 on an adjusted basis. And this would actually represent a slight decrease in their overall revenues because formerly in Q4 they brought in $24.3 million, which is higher than the $23 million that they are anticipated to bring in this quarter. And when we talk about their overall profit, Tesla is expected to report adjusted net income of $3.03 billion, which is actually $700 million less than what they brought in a year ago for the same period. So neither their profit nor their revenue are going to be very impressive for this particular quarter, and investors need to be aware of that. Therefore, investors should be prepared for the overall TSLA share price to fall or at least experience some sort of weakness. But in my personal opinion, I think this would be the best buying opportunity. Once the share price falls after this lackluster earnings report, I think it would be the best time to actually acquire TSLA shares. Because again, I am a Tesla bull, and I think Tesla stock and their TSLA stock will increase and have a great growth runway after this temporary weakness. A JP Morgan professional even commented on how the price cuts have affected Tesla's overall profitability and their revenues. He says, "We have been cautious about the profit impact of Tesla's price cuts, writing that the lower prices are negative overall for Tesla, less negative for traditional automakers such as GM and Ford, given they are now likely to lose even more money in the interim on EVs, although they have other profit centers to offset such losses, and most negative of all for pure play battery electric automakers competing with Tesla such as Rivian, as they too are likely to lose money on EVs, although they do not have profits elsewhere to offset these losses." So not only is Tesla going to experience some volatility, but also other electric vehicle makers, and luckily for GM and Ford, they have other revenue segments which will make up for any of their losses in the EV segment. But even with that being said, I actually think it's smart for Tesla to cut the prices of their overall vehicles, because as demand slows and a supply for electric vehicles increase, you need naturally, according to macroeconomic rules, to adjust the price by lowering the prices of these electric vehicles. And if you sell enough vehicles to offset this decrease in price, Tesla will bounce back stronger than ever, even though the next few quarters clearly will be volatile in their overall financials, which will negatively impact their overall share price. The good news for Tesla is that they do have catalysts coming up, such as the Cybertruck production beginning later this year and their Generation 3 platform, which was discussed on Tesla's Investor Day. We also have to look forward to Tesla's latest Gigafactory in Mexico, as well as any other news updates for this overall company. In the end, even though both Nio, Tesla, Rivian, and other electric vehicles may feel the heat over the next few quarters, over the long term, electric vehicles look to be the future. So with that being said, I would love for you to comment down below your thoughts on Sofi Technologies, Palantir Technologies, Nio Stock, and Tesla. Don't forget to go and annihilate that like button right now for more videos just like this one. Subscribe if you are new, and I will see you in the next YT video.